We're going to present today the 4 seasons of life insurance. Welcome to another episode of It's Your Life. I'm Paul Zimney, CPA and licensed life and health insurance agent. Together with my partner, Shannon Carpenter, we're going to present today the 4 seasons of life insurance. Our goal, as always, is to improve your life, your family's life, and your legacy. Hey, Shannon, I'm really excited about today's topic for this simple reason. Many, in fact, too many, people do not have a good enough understanding of the types of life insurance programs that will benefit them the most and the timing of when to put these programs in place. So the 4 seasons we're going to talk about may not apply exactly to your particular situation, but they are intended to give you some guidance, get you thinking, and provide a basis for taking action. After all, it's your life. Shannon, please introduce yourself, and then we'll go ahead and get started.
Absolutely. My name's Shannon Carpenter. I'm a financial advisor licensed in all 50 states. I'm excited to see what you got for us today, Paul. I know there's at least 13 different types of life insurance policies out there that I could just think of off the top of my head. There's probably more. But, whenever people will email me and they say, well, send me some information. I'm like, well, okay, on what? Because there's 13 types of different products. We've got 50 to 100 different carriers that we work with. Each one might have 20 different types of policies. And then each one of those could be set up probably 20 different ways. So I'm not great at math in my head, but there's like 60 to 80,000 options and variables that I could send somebody information on. So let's see what you got.
All right, very good. Thank you, Shannon. Okay, so let me outline these 4 seasons. I did this by age group. Basically, we've got the spring season, 0 to 20 years old. That's like a new birth, and that's just getting started, like in spring. 20 to 40 years old, that's the summer season. That's your early adulthood, and that's when many folks feel they are invincible. 40 to 60 years old, that's the autumn season. That's the changing, like the autumn leaves, where you're not in a young adult anymore. And then the winter season, 60 to 80 years old, well, you're getting up there now, and it's time to kind of hunker down. So we're going to start with spring. Spring, 0 to 20 years old. This is a great time to get your children started on a child whole life plan. Some plans are up to $50,000 in initial coverage and also offer guaranteed insurability for adding additional coverage increments up to or equal that initial face value amount. So here's an example. Let's say you have a 5-year-old and you put a $25,000 child whole life policy in place. Depending on the type of policy, in many cases, you'll be able to, or your child, as they become an adult, will be able to add maybe 4 or 5 times the original amount they put in place. So if they were to add all 5 times, and those usually come at 25, 30, 35, maybe some life events like getting married or having a child. In this example, they'd be able to add another $125,000 in life coverage for a total of $150,000. Pro tip regarding the spring season, also consider a universal life policy for your children. Shannon, your thoughts on the spring?
Yeah, I like the spring setup because we've got a lot of different carriers, but there's 2 that stand out in mind. One is Foresters Financial, and the other one's Mutual of Omaha. Mutual probably has the simplest approach to children's whole life. They literally can do. I'm just rough guessing numbers here, but if you did a $50,000 whole life policy on a kid, it's going to be somewhat around $20 a month. If you do 10,000, it's probably $3 to $5 a month. So they have the simplest, cheapest way to insure your child. A lot of people think it sounds morbid to take out life insurance on a kid. They think, no, I don't want to make money on my kid when they die. That's not the purpose. The purpose with this policy would be to guarantee insurability, also to lock in the rate, because as we get older, as you're going to show us later, I'm sure, especially in the autumn and the winter seasons, that rate's going to go up a lot. If you lock them in now, that rate's going to be 3, 5, 10, whatever it's going to be. It's going to be that for the rest of their life, their whole life, right? It covers them for their whole life. Then one of my specialties, the IUL. I love doing an IUL on a child. I tell parents, if every parent knew how this worked and too loved their children, they would all have an IUL on their kid. So let's say you've got 4 or 5 kids. Maybe you can't afford to put in $50 or $100 a month on a kid. The children's whole life is still a great option. It's going to earn some cash value, and you're going to have constant coverage and guaranteed insurability in the future. If you can swing, let's say $50 into a kid's policy or $100 a month into a kid's policy, imagine what would happen if you started like a 401k on a child, right? Well, these earn usually double what a 401k is going to earn. So imagine if you started 2 401ks on your child, how much money they're going to have at retirement. It's going to be a lot. I can tell you that. They are going to love you. And then they're going to do the same thing for their kids, which is going to start generational wealth. And it can all start with you. Back to you, sir.
Awesome, Shannon. Okay, let's move on to the summer season. This is age roughly 20 to 40 years old. Unfortunately, you are not invincible during this time period. And in this age range, you're generally starting a family with new responsibilities to your children and your spouse. You may very well be purchasing a home or two in this time period and taking on what is for most people the largest loan of your life. So you need to protect the younger family and the larger mortgage. God forbid you would die in a car wreck and your spouse has to suddenly raise children with little or no income and potentially move out of the family home, all because you didn't have adequate life insurance, again, because maybe you felt you were invincible and there was no need to get that protection in place at that age range. What products are good for this age range, this summer age range? Well, first of all, term life, large face values, 200, 300, 500,000 or more. If you're in good health, and these policies are very, very affordable. Pro tip, ask your insurance agent about whether they offer return of premium term life programs where essentially you get all of your premiums back if you outlive the policy. Okay, another program, as Shannon mentioned, Indexed Universal Life. We discussed that in a previous podcast. This is a long-term life product that also grows retirement savings. Pro tip there, you'll get more bang for your buck, just as Shannon was saying a few minutes ago for the 0 to 20, when you take out the universal life programs at a younger age. And then the third one that some people don't think about, but really more people should take advantage of this, it's so inexpensive, is a simple accidental death policy. That means if you pass away due to an accident, it pays the face value. Number one cause of death up to approximately 44 years old is due to accidents. So unfortunately sad but true, but why not have this extra protection for what is statistically the most likely way in this age group for you to pass away and your income, cease to exist. Another pro tip, ask your agent if the accidental death plan offers a 100% return of premium rider, just like what I discussed earlier. Shannon, your thoughts?
I think that's genius. I mean, if you think about it, like you said, if you're going to die in your 20s and 40s, more than likely it's going to be due to an accident. So, especially if you do that return of premium. I mean, let's think about this. I don't know if we're allowed to legally call this a free policy, but I'm paying premiums in for 30 years. I don't die, whether it's the term or whether it's the accidental. I don't die in that 30 years, which there is a 99% chance I'm not going to die during the term. Term policies have a 1% chance of you ever, where your beneficiary ever seeing that money because they know the mortality charge. It's like Vegas. The house typically always wins. Occasionally, somebody wins the lottery. But I hate to say it that way because I mean somebody passed away and you got the check is what I'm saying there. But if you don't, you get all your money back. That's a free policy, and especially if you're a business owner and you can use Section 162 of the IRS tax code. I mean, you're a CPA, so again, I'm not telling you anything you don't know, but that allows someone to write off the premiums for their policy.
Very good, sir. I appreciate it. Okay, let's move on to autumn. So this is roughly 40 to 60 years old. Okay, so this is a time period when your life really starts to shift. Generally, children become grown-ups. If you stayed in the same house, your mortgage balance has decreased significantly, or maybe you've even paid it off by now. You're still in your prime income earning years, but you're starting to think about preparing for retirement. These are the years where you better put some serious life insurance policies in place, and I've got two important reasons for doing that. Number one, the cost of coverage to you increases dramatically each year during this time period if you wait to put something in place. And number two, serious health issues begin to surface during this period typically, which further drives up the price of life insurance or makes it difficult or even impossible to qualify for coverage. So a pro tip here, always study the differences in coverage amounts, cost per unit of coverage, cash value, and cash accumulation in the main products we're talking about, the whole life, the term life, and the universal life. And very important, always review your options with a specific purpose or purposes in mind. Where are the proceeds going to go? What are they going to be used for? And who is going to benefit from receiving these monies? Shannon, your thoughts on the autumn season?
I like Autumn's lineup. The Universal, obviously, again, one of my favorites. I would say in the Universal Life range, if you're doing an IUL, more than likely, it's not so good if you're over 50 because you have a rising cost of insurance and the rising fees. But it really just depends on your situation. Everybody's different. So it depends on how much you're contributing. If you're contributing enough, then it can still be a good product. But typically for the IUL, I would say let's go 50 or under. One thing I would switch to is if you're 50 or older, really at any age, is using mutual whole life, which is a little different. So whole life, gives you that usually a guaranteed, let's say 4 to 5% interest rate. So it's going to grow some cash value. But what I see when I review people's policies they've had for 30 years is the cash value after that amount of time is just now worth what they've put into it, right? So if that's you, one, you can 1035 exchange that, roll that cash value into a mutual whole life or an IUL. But with the infinite banking concept, as they call it, the mutual whole life, not only do you get the 4% guarantee from the whole life, but you also get a dividend payout. And the companies we use have an average of around 5 to 6% on their dividend. And by the way, that's for Foresters, that's a 150-year average of 5.8% on the dividend. So you take a 5.8% 150-year average dividend, you combine that with a 4% guarantee, and you've got 9.8%. So can't legally call the whole thing a guarantee, but if they've not missed one and during the Great Depression or World War II and market crash, tech bubble, 9/11, even coronavirus, I would say that that's a pretty safe bet even today. And the reason that policy is so popular now is because you can put money in and pull money right back out. So imagine if you took 100,000, dumped it into a 401k, and then you borrowed 90,000. One, you'd have to make scheduled payments back to it. Two, you're only earning interest on the 10,000 that's left in your account. With mutual whole life, if you dumped in $100,000 and then you borrowed 90 out, you can borrow that out usually within about 30 days. Then it's called a non-direct recognition loan. So when you check your balance the next day, even though you withdrew 90 grand, you still show you have $100,000 in that account. You're still earning roughly 10% interest on the entire balance. And hopefully you use that 90,000 to buy a productive asset that's making you even more money, like a rental property. That's all I've got, buddy. Back to you.
Okay, last season we're going to cover the winter season. This is roughly 60 to 80 years old. And by the way, we cut off the seasons at 80 or 85 because after those ages, typically you can't even qualify for any type of life insurance programs. Point that out. Okay, now we're moving into the age range, which includes the average life expectancy, or in other words, the expected age of death. Ouch.
Yeah.
As you can imagine, life insurance is at its costliest and most difficult time to qualify. So hopefully you're already well covered or getting coverage in the early part of this winter season. Pro tip here, very important. Do not rely on your work life insurance to be your main or only policy. It's very likely that it's a group policy, and that's why it's so cheap for you or the company, that you will end up losing or having to pay a ton for when you leave employment. The good news is many in this age range have no or little concern anymore about paying for children's colleges or a new oversized mortgage, and therefore there's generally a lesser need for a larger life insurance policy. If you've got a reasonable retirement planning, including pensions and Social Security, generally the purpose behind life insurance in this age group is to cover funeral costs, provide some level of mortgage protection if one exists, and to leave some monies behind to loved ones. A whole life policy with a lower face value usually accommodates the needs in this age group and is easier to qualify for than other products, especially if one has a serious or a history of moderate to serious medical conditions. Final pro tip, as Shannon has been discussing, also look at taking out an index universal life policy to help with retirement. And this offers the flexible premiums that you can adjust your premium up or down throughout the term of the policy. Shannon, back to you to comment on the winter season.
Sure thing. So, you just said it. What I was thinking when you said the IUL, previously I just said that, we don't really like IULs if you're over 50. That's if you want to use them the traditional way, which is going to be used to structure for max funding so that you can use it as a retirement, life insurance retirement planning, LIRP, funny word, right? Easy to remember, life insurance retirement planning. But in IULE, the express version, typically is not set up for cash growth. So, we have this on our Ethos portal. They have a really good one. It's brand new. I mean, it just came out, a few months ago, and everybody's killing it with that product. It's very easy. But with those, you can basically customize the product. You can say, I want to give somebody that is 60 years old and in good health. You do have to have good health to get an IUL. But I want to give that person a permanent death benefit of, let's say, $50,000. But where whole life was going to be, I don't know, I'm making this up, let's say $150 a month, maybe I can do an IULE where I structure it properly to where it's going to give them permanent coverage, but only charge them $100 a month. So it's a little bit cheaper on them. And that's how I would use the IULE. So not so much for cash growth, but just for permanent coverage focused versus retirement focused.
Thanks, Shannon. And we appreciate your attendance today for the 4 seasons of life insurance. Take care, everyone, and we will see you again on another episode of It's Your Life.